can you show me your call debit spread filter? I'm looking for maximum benefit for lowest cost. All right. Let's go to Bull Call Debit real quick. And I'm going to go to the search tool. Karol, during this discussion, I had mentioned certain things about the risk-reward ratio of looking at credit spreads or debit spreads, parity trades of each other, but a bull put credit spread is the parity trade to a bull call debit spread using the same strikes and expiration. When we entered in that bull put credit spread discussion revolved around the iron butterflies at the beginning of the presentation, I talked about higher probabilities that look for an 8-to-1 risk-reward ratio, meaning I want an 85% probability that the stock is going to stay at or above the strike price of the options I sold. I'm looking for a double-digit return, but I'm taking an 8-to-1 risk-reward ratio. This is just a search that we created on July 12th on a similar webinar, Karol. We looked for options 1 month out in time with a return of at least 10%, 3% in the money for the debit spread with a 75% probability of success. With looking, of course, stocks trading up above the SMA 50, avoiding earnings between now and expiration. That's this default search we created. Rocket companies at $17.97. In the money bull call debit spread, I might sell the 15 strike call for $330 midpoint and buy the 14 strike for around $415 midpoint. A debit of 85 cents to make $1 back potentially, or 15 cents maximum profit, 17.6% return with an 84% probability above. Okay, and so this is the deep in the money, relatively deep, but this is the in the money bull call debit spread. Now, our defaults are looking for something similar. If I looked at just initial values, it's going to take me to a monthly screen, September 24th, with similar criteria, probability of 70, stock trading above the 20-day or 50-day moving average, avoiding earnings between now and expiration, as we looked at as well for David, because we don't want that unnecessary surprise where we're at full loss on the position. Okay, and then, of course, you have a weekly default. This is going to look shorter term. We're still looking for that 75, 80% probability above, avoiding earnings between now and expiration, good average stock volume, stock above the SMA 20 or 50. I might even use some MACD conditions in there as well, Karol. Okay? But what am I still looking at? I'm looking at positions that have a 70, 75, 80% probability double-digit return. Now, that initial trade that we showed was about an 83% probability on Rocket. We are selling the 15 strike call on a stock trading at about 17. We are buying the 14 strike and we are paying a debit of 85 cents on a bull call debit to make 15 cents. Or what we saw is a 17.6% return on the position with about an 83, 84% theoretical probability that Rocket would stay above 15 in the next 20, 21 days, whatever you set it up as. Okay? But that again is what? It's essentially a 7-to-1 risk-reward ratio, 6-to-1 risk-reward ratio, really. So I'm risking 90 to make 15. So we're at about a 5.75 to 1 risk-reward ratio. You said you're looking for maximum benefit versus lowest cost. Okay, 17.6% return with an 83% probability. And that is, what did I just say? A 6-point-something% risk-reward ratio. 6-to-1 risk-reward ratio, roughly. All right. Now, just as we talked about earlier with the out-of-the-money credit spreads / iron condor position versus an iron butterfly that has a much higher percentage return and lower monetary risk than the iron condor in the same stock that has the wider wings, why wouldn't I take the iron butterfly all the time? And it's because you don't make that maximum profit that often. So this is the search tool, what we're talking about. And you have the opportunity to adjust it any way you want. All right, these are just defaults to get you started. In addition to what's in the search is those default settings. You can also go to the sample searches menu for more themed searches. And we have one that's called out in time out of the money, Bull Call Debit Spreads. Look at my returns now, 92, 68. I'm not looking at 15, 16, 17% returns. I'm looking at positions here on Skechers, for example, at 62.45. Rocket's not in here. I looked for that real quick, but it's not there. I'm selling the just at the money 62.5 November call for around 485, and I'm buying the November 60 call for about 630. I'm paying a debit of 145, but if the stock stays above 62.50, I get 250 back. I'm looking at a 73% return with a 49% probability of success. Okay? Now, the reason why I'm going in this direction is there's multiple ways to trade debit spreads. This is a different approach that's available for you on PowerOptions to find positions that match our other stock criteria. But instead of having that 6-to-1, 7-to-1, or 8-to-1 risk-reward ratio with that 83, 85, or 90% probability, we're looking at positions with a 48 or 49% probability, but close to a 1-to-1 risk-reward ratio instead of a 7 or 6-to-1 risk-reward ratio. But there's only a 48% chance that you're going to see this profit on a consistent basis. Most people who use this approach, is this maximum benefit for lowest cost? That's what you kind of asked me, isn't it? That's exactly what you asked me. Instead of paying $6 to enter a 10-point spread that's in the money, $8 to enter a 10-point spread that's in the money, how can I get that risk-reward ratio closer? Well, this is the at or out of the money debit spread approach. But you have a lower probability of receiving the maximum return, and most all people who use this approach never expect to even hold this position long enough to get to that maximum profit. They're going to close it 15, 20 to 30 days in if they get anywhere close to 35, 40, or 50% of that maximum profit they expected. This isn't to hold all the way to expiration and say, hey, 50% of the time, if I make 72%, I'm going to have a huge profit. They don't hold it that long because you can't. And of course, more often than not, especially in the last 3 to 4 weeks, now you did bear put debits, we'd be in a different position, but in the last 2 to 3 weeks doing these, most of your far out in time, out of the money, at the money bull call debit spreads are probably near 80 to 70% loss on the position, just by the market conditions. Let's take a quick example. We're at 6:05 p.m. Eastern time. Let's review real quick. Bull call debit, bear put debit spreads. We have defaults for you to use as a stepping stone based on our criteria: weekly, monthly, safer, initial values, deeper in the money, using leaps far out in time. Although we have our defaults, you can customize it any way you want to, looking for implied volatilities, maximum net debit, return, range in or out of the money, deltas, delta ratio of the two options, bid-ask spread, stock technicals, beta, percent of 52-week range, RSI, Bollinger Band ranges, stock above the 20, 50, 100-day, or 50-day above the 100, 20 above the 100, days the stock's been above SMA 20, SMA 50, number of days stock's down. MACD is one I particularly use for my bull put credit spreads, which again is a parity trade. Fundamentals, basic stock price range. Not concerned with the debit spread too much. I'm only worried about my cost and the width. Earnings per share growth, PE ratio, market cap, dividend yield. Wouldn't use it for this. Earnings date, avoiding between now and expiration, ex-dividend date. And then, of course, the list, if you just want to screen for bull call debit spreads across your 50, 60, or 40 stocks, you could create your own list and do it that way rather than searching across the entire universe of options for any bull call debit spread that meets your criteria. At the same time, themed searches also that you can use and adjust in the sample searches, looking for the ETFs, safety first, large cap stocks over 10 billion with a high probability would have smaller return. And then that out of money, out in time bull call debit spreads that we saw. The rocket position from the default in the money position, 83% chance probability. This was a 42-day out trade, double-digit return, but a 7-to-1 risk-reward ratio. And then the one we saw from the Skechers one here, 72.4% with about a 40, okay, let's call it a 50% probability. But as we also showed, looking at the profit and loss chart for the Skechers position, we're probably near 75, 80, 80% loss, even though, oh, sorry, that's not what I wanted. 75 to 80% loss on this debit spread with the market conditions recently from where we might have entered the trade. If we entered the trade 2 weeks ago, you see what I mean? You know, if we had done it when Skechers was higher at say 67 or 68, we might have sold the 69 call and bought a 67.50 or something along those lines. And now we're out of the money. We still have 98 days to go. We're probably at a 60, 65% loss in that spread.